Hi everybody, welcome back to T.U.B Investing YouTube channel. And I've been a bit late in this uploading of this video, but nevertheless here it is. So the market has been rate, my portfolio has been rate for the most of 2022. But I've come to this realization recently, and I want to tell you that this will be the most important video that you will need to watch in 2022, even if it has only 1 week left. Before I continue, let me have a disclaimer that I'm not a financial advisor, but please please like, subscribe, and ring the notification bell for this video. So as you can see, the market has been red and everybody is talking about going back to basic, right? And investing 101, looking for profitable company, focusing on company generating free cash flow. So what is free cash flow, right? Calculating free cash flow is taking the operating cash flow and deducting the capital expenditure, such as the purchase of the property, plant, and equipment itself, and that will give you the free cash flow, which in this case is called FCF. So I'm showing you now is a free cash flow statement from a company called Company A, and then as you can see, it's divided into 3 sections: operating activities, investing activities, financing activities, and eventually it states whether it's an increase or a decrease in their cash and cash equivalent, right? So operating activities, it actually adjusts for all the non-cash items, components in the income statement, right? So this includes depreciation, amortization, stock-based compensation, right? Allowance for credit losses, and then subsequently it also made add back if there's a cash inflow, or deduct if there's a cash outflow in their working capital changes. So that will be deemed as the changes in operating assets and liabilities. So that will be the working capital changes. And then subsequently, that will be the end of the net cash provided by operating activities, which is the first figure that you use in your calculation of free cash flow. Subsequently, is in the cash flow statement is the investing activities, which relates to the purchase of investment, sales of investment, and then some capital expenditure, which is here, which is the purchase of property and equipment. So this is the capital expenditure. Capitalized software development costs, that is, you can calculate it as part of the capital expenditure as well. And then business acquisition, right? So then subsequently it goes into the net cash use in eventually the summary of the net cash use in investing activities. Then you go on to financing activities, which is related to debts, the increase of debt, the use of debt, the payment of debt, and also the proceeds from stock purchase plan, stock exercising of stock options, as well as any secondary offering of their shares, right, in the market. So that will give you the net cash provided by financing activities. Eventually, this company has losses. The company A has losses, end up with positive operating activity. Net cash provided by operating activities has a cash outflow in terms of investing activity, cash inflow in terms of financing activity, and that eventually led to an increase in cash and cash equivalent of 240 million. So I look at here, there's a company B, right? So company A and company B, they are in the same industry itself, right? So company B has a net income of 26 million. If you go all the way down, adding back is non-cash item, and then subsequently make changes, increase, put in the increase or decrease of in terms of their working capital changes, right? So in terms of the assets and the liabilities, and subsequently you come up with the net cash provided by operating activities. Simple, their net cash from investing activities is simple, it's just capital expenditure. And then subsequently the financing activities, where they actually made a large repayment for the last 6 months, right? So they have a huge negative net cash provided by financing activities, and eventually that led to a negative change in terms of their cash and cash equivalent, right? So so as this video, I'll be comparing company A and company B eventually after that on their net free cash flow, right? So as you can see, these figures are taken from Yahoo Finance. And they have done the service of actually providing me the free cash flow itself operating cash, as you can see here, first line is operating cash flow, deducting capital expenditure, you get a free cash flow. And I actually included a line of stock-based compensation, which is a non-cash item that's added back in the cash flow statement before you get free cash flow. So it's included, this amount is included in the operating cash flow itself. As you can see here, the difference between company A and company B. Company A stock-based compensation is significantly higher than company B, but regardless, over the last 5 years, right, both of them has actually increased their stock-based compensation, right? So maybe at this point in time, it's good to understand what is stock-based compensation. It's basically something, in my opinion, is a form of salary or encouragement or alignment of interest between employees and the company or even investor, right? And this stock-based compensation can be underwater or can make an employee very rich, right? And eventually, my opinion on stock-based compensation is that it's a form of salary, it's an operating expense, right? Regardless whether it's alignment or not, right? To me, it's a form of salary, it's an operating expense. It is already deducted in the net income statement, and it shouldn't. At this point, I'll just say that it shouldn't be added back to the cash in terms of the cash flow statement, because to me, it's also a dilution at the expense of shareholders, right? Any stock-based compensation is a form of dilution and is at the expense of investors, right? Because we are not really have any says in terms of this kind of stock-based compensation. We can't vote on it, right? Basically, it's between the company and the management, or the management and employees, right? So at the end of the day, like as I said just now, there is also some form of alignment of interest when between the employees and the companies and the investor. However, if only when the share price is high, when the share price is low, right, it actually causes more dilutions, because the stock-based compensation could be tagged at the share price, the more recent share price, which is right now, as you can see at the start, right? I say the market is on the free downfall, right? The market is red, right? So the share price right now for most of the stocks right now is definitely much lower than what was given the last 2 or 3 years, right? So as I conclude here in the last statement, when you give out more stock-based compensation at a lower share price, it may mean that the company is either burning cash or preparing for the worst, right? That's just my opinion. But at the end of the day, stock-based compensation, in my opinion, should not be added back to, in terms of it will be added back in the cash flow statement, but it should not be taken into the calculation when you calculate free cash flow. So in this sense, I actually took out the stock-based compensation from the free cash flow, and I concluded it with a final line here for company A and company B, which is deemed as the FCFX excluding stock-based compensation, SBC in this sense, right? So you can see for the trailing 12 months, company A FCF excluding stock-based compensation is negative 91 million, and company B SCFX SBC is actually positive 93 million, right? So that is a huge difference, right? Although, and when people look at this, right, people are amazed at how stock-based compensation can cause such a huge difference in the free cash flow, right? So before I continue, I will just say that my opinion is that stock-based compensation should be removed from the free cash flow itself. And revealing now that I actually said that the companies are in the same industry, and the two company A is the trade desk, and company B is one of my bigger position, which is Digital Turbine. The trade desk, the share price now is definitely still higher than what's over the last 5 years, maybe since 2018 and 2019. Similarly for Digital Turbine, it's the same. And when you look at this, right, the market cap for the trade desk is 21 billion, while the market cap for Digital Turbine is 1.397, right? Sorry, I got a mistake here. The market cap for Digital Turbine should be 1.397. If you look at this, right, despite the differences in the FCFX SBC, right, trade desk market cap is actually 15 times more than Digital Turbine, right? So if you look at the free cash flow, although it's huge, and people may have I would say, in my opinion, they have an incorrect view on the company, without considering stock-based compensation itself, right? So before I end, right, that I actually found this Twitter by Compounding Quality, which is quite interesting. It has a picture of a Trojan horse, and then and the management is deemed as no, telling investor, right, this company is damn good with a lot of free cash flow, but actually there's a lot of this Trojan horse has a lot of stock-based compensation, which is the trap itself, right? To trap in these investors. So I would say that, as per Compounding Quality Twitter account, he stated here, always subtract stock-based compensation when you are looking at free cash flow of a company, right? Which is what I also want to say in this YouTube video itself, right? So please, when you look at free cash flow, please deduct stock-based compensation from the free cash flow itself to determine what is the actual free cash flow of the company. So that is the end of this video. Please like, if you're still watching here, please like this video, please subscribe to my channel, and that's it. I hope the next video will be better. See you again. Bye.